Corporate formations and capital structure. Picking a way to organize a business is the first major decision that is made for most companies. It's important because of many different characteristics that each form of business has. Sole proprietorships have some advantages over corporations and partnerships and some of the other forms, but also some disadvantages. The same with partnerships versus LLCs, corporations, and vice versa. This is true for many business reasons, but especially in the context of tax. The biggest advantage of a sole proprietorship is its simplicity. In the context of tax consulting and tax characteristics and tax consequences, a sole proprietor is the same entity as the individual that owns it. So the individual is only taxed one time. Because of this, cash can be withdrawn without being taxed as a dividend or taken out of the company. Some of its other advantages are that individual marginal tax rates are currently and usually lower than corporate rates, and again, because taxes are only calculated at the individual level, normal business losses can offset an individual's other non-passive income. Probably the biggest disadvantage of being a sole proprietorship in terms of tax consequences is that you can't just leave money in the business and not have it taxed. In other words, the IRS assumes any money that the company makes during the year is going into your pocket as an individual for tax purposes. So even if that is not true, you are still going to be taxed as if it were true. You really don't have to do anything in order to form a partnership. Basically, if you're involved with any kind of joint venture for profit with at least one other person, you are in a partnership unless you formally elect and follow the steps and processes to become something else, some other form. So if you start a business and don't formally choose a business form, you are a sole proprietorship if it is just you, and you are a partnership if it is more than just you. However, what usually happens is each person who is forming a partnership contributes some amount of assets to the partnership in exchange for a proportional amount, at least in fair market value, of capital within that partnership. These are some of the overall characteristics of limited versus general partnerships. These aren't directly tax related, but important to consider nonetheless. In general partnerships, all partners generally take an active role in management and operations of the business. In a limited partnership, there are partners that only contribute assets and aren't involved in the management of the business or its operations. Partnerships share some of the same advantages as sole proprietorships. A partnership as an entity does not pay taxes. A partnership does file an informational return each year to the IRS that sets out the profits and losses that are going to be passed through to the individual partners. The biggest disadvantage of a partnership, and a sole proprietorship for that matter, is that the personal assets of individuals or individual partners are not shielded from liability. In other words, they can be attacked by would-be lawsuits. Obviously, this is not a tax implication, but in terms of just general disadvantages, that's probably the biggest one. In terms of tax disadvantages, partnerships and sole proprietorships function very similarly. This graphic basically just shows that a corporation, whether it be a C corporation or an S corp, is owned by various shareholders, and that they aren't necessarily connected one to another, A, B, and C in this case. From a tax standpoint, the biggest advantage of a C Corp is probably the ability to give shareholder employees tax-free fringe benefits. However, most people don't organize corporations for a tax benefit. In fact, corporations, at least C Corps, are probably the least advantageous form of a business from a tax standpoint. However, they do offer many other advantages which offset the negative tax effects and make it the business form of choice for many businesses. From a non-tax standpoint, the biggest advantage of a C Corp is generally the ability to generate capital by selling large numbers or large quantities of shares of stock. As I said in the previous slide, C Corps are pretty disadvantageous from a tax standpoint. The overall biggest disadvantage of a C Corp from a tax standpoint, or otherwise, is the double taxation of dividends. This means that as an owner of a corporation, earnings of the company are taxed twice before they get to you. The C Corp as an entity is taxed and files a tax return. And then owners are taxed when they receive any type of distribution or dividend from the corporation, thus resulting in double taxation to the owners. S Corps are a bit newer than C Corps, and they are a type of hybrid entity that merges some of the advantages of C Corps, like the ability to sell stock for capital needs and limited liability, with some of the benefits of partnerships and sole proprietorships, such as the fact that income is only taxed once at the individual level. Like partnerships, S Corps file only an informational return at the entity level, and then the earnings, profits, and losses are passed through to the individual owners. Most of the disadvantages of S Corps are shared by partnerships. However, some unique disadvantages are the added complication of forming the actual business form, the S Corp. And when compared to C Corps, there are also more stringent requirements and limits set on who can be a shareholder. LLPs, which stands for Limited Liability Partnership, and LLCs, which stands for Limited Liability Companies, are both types of hybrid forms of organization. The main difference is what types of business use them. Both have a lot of the advantages and disadvantages of the partnership entity from a tax standpoint. LLPs are generally used by large personal service companies such as law firms, accounting firms, and sometimes even doctors or medical practices. And then LLCs are used by all types of small businesses, but anyone that is looking for some of the hybrid benefits between a corporation and the limited liability that provides and some of the tax advantages of partnerships. Now, Section 351 basically governs the transfer of property in exchange for stock to a company. And it provides for the non-recognition of gain or loss by the transferor of the property to the company if the transferor is in control of the corporation immediately after the exchange. The idea behind that is basically that if I'm giving transferring property to a company, that as soon as I'm getting stock in return, so I'm upping my ownership percentage in this company, and if that ownership percentage after I make the transfer is high enough that I'm considered to be in control of the corporation after the exchange, it doesn't make sense for me to recognize a gain or a loss for property that I transfer in effect to myself. Obviously, it's not transferred to myself, it's transferred to a company that I control. But if I have enough stock to where I'm said to be in control of the company, in effect, what's basically happening is I have just given property to myself. And obviously, it would not make much sense to tax the gain or recognize the loss when that occurred. Now, obviously, if then the company later sells it down the road, that's a different story altogether. But at the outset, when the transfer occurs from the transferor to the transferee corporation or company, as long as I have that control of the stock, then I'm able to not recognize gain or loss. So what basically happens is then the shareholder takes a carryover basis from the property to the stock, which basically means whatever the basis was in the property is now the shareholder's basis in the stock. Alternatively, you can calculate the basis in the new stock with this equation here. Fair market value of transferred property minus any deferred gain or add any deferred loss, and that becomes the new basis in the stock. So this is just an illustrative transaction where A and B are transferring property to this new company. I won't get into a lot of the details here since it's kind of just a flow chart, but it does at least show what the new basis there would be. This is a similar flow chart, just showing what the gain or loss would be, and if this does or does not get 351 treatment. Moving over here, we see how you define whether you control enough of the company to get that non-recognition treatment after you have made the transfer of property or assets for stock. So 368C defines what control means in that context, and it means 80% of total combined voting power of all classes of voting stock, and 80% of the total number of shares of all other classes of stock, such as any non-voting preferred stock. So any different class of stock that exists, you have to meet this 80% threshold for. These are some of the questions that, as a tax professional especially, you're going to want to find out or know the answer to when these transfers take place. So 351 will govern whether there was any realized gain or loss. Whether there was any, well, it won't govern whether there was any realized gain or loss. That will either be or it won't be. But if there's a realized gain or loss, 351 will govern whether there's a recognized gain or loss. Then you are going to obviously be interested in what the character of the recognized gain or loss is, what the carryover basis to the new company stock is, and what the holding period is. And obviously those are important. 3, 4, and 5, well, 3, obviously, if you know the character of the recognized gain or loss, that's going to determine, if it's long-term versus short-term, the rate at which, for instance, a gain is able to be, or a gain is taxed at, the rate that it's taxed at, whether it's short or long-term capital gain. And then also, how you're able to deal with the loss, what that loss is able to offset. And then 4 and 5 there basically are questions that help you answer the character of the recognized gain or loss. Boot often comes up in the context of 351 transactions. So boot can be any of the things you see outlined here: cash, notes, property, securities, stock in another company, but not stock in transferee company. Okay. If we want to compute the shareholders' basis, there's two portions of that we need to compute. The basis in whatever boot is transferred. So whatever of these items is transferred will have a different basis than whatever the company stock that is received, what basis that has. So in this scenario, we have A and B property transferred to new company plus gain recognized minus the fair market value of any boot received minus cash boot received minus liabilities assumed by new company, and that gives you the adjusted basis of stock received. Now, this illustration here shows essentially how to allocate any gain that's recognized. So you see what we've got is some equipment and some land that are part of this transfer. The fair market value of the equipment is $30K land 70K, so we've got a 30-70 percentage split. The adjusted basis really only goes to help us understand what the realized gain is on both of these pieces of property, or equipment and property. So in return for us transferring our equipment and land to this company, we're getting $50,000 in cash, which obviously is considered boot. And we're also getting 50 shares of new company, which is 100% of this company. So the shares obviously count for qualifying this transfer as a 351 transaction. However, since boot is received, we need to allocate the gain recognized of that boot between the two pieces of equipment or property here. So we allocate based, you see the amount we allocate here, 15K, 35K, that's based on the 30-70 split. And then the gain that's actually recognized is either the amount allocated or the realized gain, whichever is less here. And then here, what's recognized is the either the allocated boot or the realized gain, whichever is less. Again, these are some questions that you want to ask or know the answer to that 351 helps to determine based on, the effect on the transferees. So this would be the company that's actually receiving the equipment or assets in exchange for stock. Same questions, just now in terms of transferees versus transferors. So, the transfer of new company stock or debt issued by new company in exchange for services, property, or cash, if that's what the transfer is, no realized or recognized gain or loss to the company. New company's transfer of property to new shareholder equals gain is recognized as if it had been sold. So basically, you're going to treat the transfer of property from new company. So if I'm talking in terms of I'm the company and I give you property in exchange for something else, we're going to, this is basically going to look kind of like an arm's length agreement where we're going to recognize gain or loss based on the actual transaction. But in terms of the 351 losses, in terms of this transfer of property, those losses are not recognized until the property is later sold. So the effect of a Section 351 transfer to transferees in terms of their basis in the property received is as follows. Or I guess an easier way to put that would be, what is the new company's basis in whatever property that they receive? So you basically just take the adjusted basis of the entity or person transferring the property in exchange for stock. So we're the company, we're giving stock, they're giving property. Whatever their basis was in that property, we will add to that basis any gain recognized by the transferor and subtract any reduction for any lost property. So here's an example. Bob transfers to new company a piece of land with a fair market value of $20,000 and adjusted basis of $2,000 in exchange for 100% of new company stock. Bob has owned the land for 2 years. Obviously, in exchange for 100% of new company stock, it's property that's being exchanged. This should just scream on its face, Section 351 treatment applies. It does. Then new company takes the adjusted basis in the land of $2,000 because that was the adjusted basis of the transferor, and the holding period is tacked from Bob's original holding period. So basically, again, tracking back to the reasoning behind all this, if Bob's transferring anything to a company that he owns 100% of after the transfer, we should treat it just like Bob didn't really do anything with that property. And in this case, that's what we're saying. Okay, this next scenario, section 351 is not going to apply to, and we'll see why. Bob transfers to new company a piece of land with fair market value of $20K, adjusted basis of $2K, in exchange for 50% of new company stock. Bob is on the land for 2 years. Well, obviously, that 50% is the reason why Section 351 does not apply. So in that case, Bob recognizes $18,000 in gain because he's transferring it at a fair market value of $20,000. That's $18,000 more than his adjusted basis. And then new company will take the full $20K basis with a new holding period as if this was just an arm's length transaction. Don't have too much to share on this slide. You can just read that over. That's just a continuation there. So in terms of assuming the transferor's liabilities, if the transfer is not under a like-kind exchange rule, which is section 1031, we assume that any assumption of shareholder indebtedness is not the equivalent of receiving cash. So what basically this boils down to is if I, as the company, assume some of your debt in this 351 transaction, we're not going to call that assumption of debt boot. And that's kind of what this is getting at here. The biggest point here is this kind of second big bullet point. If liabilities that are assumed are greater than the basis that shareholder has, then the transferor, which is the shareholder in this case, must recognize excess liability as gain. Assuming new company assumes transferor's liability. So we're adding that piece to the puzzle here. And calculating basis with a transaction that involves assumption of liabilities. So whatever assets transferred, you start with that initial basis. Add any cash transferred, add any gain recognized, excess liability over basis. So this is basically any assumption of liability that's above and beyond your basis in that asset, minus transferor's liability assumed by new company. Add all that together, make that last subtraction, and you've got your new basis. One more example here. Stonebriar Incorporated wants Robbie's Sporting Goods to locate in its new mall that it is developing in Denton. It offers Robbie's a tract of land on the mall site upon which the sporting goods store can be built. Fair market value of the land is $1 million. Stonebriar's adjusted basis is $100,000. In that case, Robbie's does not have to recognize the $1 million in income, but it must take a basis of $0 in the land. So basically, since no money was used to purchase the land, that's where the $0 basis is, which basically just turns this into a deferred gain because we're not recognizing the land as income to us now. But if then we go and sell that tract of land later on, and starting with a $0 basis, that means whatever we sell it for, that entire amount is gain. So we would just be deferring that gain until such point that we ended up selling that asset. Some tax planning considerations. Section 351, assuming that you meet the qualifications, is not elective. You have to do it if you meet it. So that's where a lot of the tax planning occurs, is do I want to qualify and have to take it, or do I want to avoid it? If I want to avoid it, then maybe I acquire 79.5% of the stock instead of 80. That's probably the biggest part of tax planning considerations for 351 transfers. And obviously, there's a lot of tax planning that goes into selecting the entity that we talked about at the beginning of this chapter. That really needs to be done not just with tax planning, but in conjunction with overall business plan to, again, not just look at how much tax you can avoid or save money on, but look at what the overall result of the transaction